Thank you everyone for joining us in your busy schedules. Obviously, we're very excited to see the kind of little community that's starting to grow. It's been great to see the interest and the feedback kind of increase as well. So thank you to all who have been here for a few of these. Thank you to everyone who's coming for the first one as well. Without any further ado, let's go ahead and just get into some of the topics that we have for today. So to start off, in the email that was sent around previously, we had four major topics. It was the new administration's impact, demand outlook for 2025, the global perspective, and then also the longshoreman strike, the port strike that had a contract which was due to expire yesterday. In somewhat late breaking news, the union leadership and the management had come to tentative agreements, while details of the deal are still kind of under wraps and giving opportunity for union members to review. We kind of view it as there was such a significant impasse going into this that it was pretty surprising that it seemed like there was a tentative agreement. It seems like it's potentially maybe 60-40 that the union members are going to agree. So we'll have to keep a close eye on exactly what happens, but it doesn't seem like it's all but guaranteed immediately. So we'll keep a close eye on that. Moving into kind of the broad economy, maybe set the table before we start talking about some of these shocks. The GDP is going to be always a great place to start. So U.S. domestic GDP is obviously nominal, seasonally adjusted, and annualized. You can see that essentially since the beginning of 2000, we saw pretty steady growth rates with a few recessions, obviously a more significant one in 2008, and then following the pandemic-induced recession, more significant and really encouraging rebounding growth rate from there. Moving more into the kind of details and the components of where that impressive growth has come from, the main driver we've seen consistently here is going to be personal consumption. So that's the impact that the U.S. consumer is having on GDP, on growth. It really has been one of the primary drivers. When you look at underlying fundamentals, we anticipate that that's going to continue to be a real benefit, a real buoy for growth going forward. We also have the long run kind of growth rate from the Congressional Budget Office. They have it at 1.7%, given kind of the mix of upcoming policies, the strength of the consumer, and the industrial sector potentially moving out of the contraction recession that we've recently been in. We do anticipate that throughout 25, we'll be performing well above that 1.7 long-term growth rate for GDP. Moving to another macro factor, that's going to be the labor market. I want to draw everyone's attention to the chart on the top left here. That is non-farm payroll. So it's how many jobs were added on a monthly basis with the kind of horizontal bars, or with the bars that are coming in. The red or reddish orange line is going to be the 6-month moving average there. What we can see very clearly is that even though there was some weather impacts on a few of the individual months over the last couple of years, the growth potential for the U.S. economy remains very, very healthy in the labor market. We anticipate that we're going to remain above the long run rate of 110 again throughout the year, and that there's actually some potential risk to increase on labor pressure, to a resurgence in payroll growth, in the very near term. Some of the other labor components to keep an eye on: initial jobless claims have really been very impressive and kind of confirm the fact that the labor market's well intact, and that there's very little risk to severe labor deterioration. We also have challenger job cuts, which are kind of right in line with seasonal norms. Nothing that really flares or flags significant deterioration or concern. And then we also do have an openings per worker rate that still is above 1. So, when you look at it more broadly, the labor market is very healthy and well intact. The other kind of key thing that's obviously been a pretty significant part of the zeitgeist recently is going to be inflation. The data points that we're looking at here, the shaded region with the gray, it's going to be the PCE, so personal consumption expenditures. That's the measure of inflation that's used by the Fed. That's the one that they're targeting to get down to 2%, which is that red dotted horizontal line. We also include PPI in orange. We also have CPI, which is another measure of consumer price impact, the consumer price index in light blue there. What you can see here pretty clearly is that after really flaring throughout 21 and peaking in the beginning of 22, there's been a general trend of disinflation, but as expected, especially from the middle of last year till now, it's been a rocky road. It's been pretty bumpy, and we haven't seen that final leg, the 3 to 2%, 2.5% to 2% kind of final leg. We always knew it was going to be the most difficult, just given kind of base effects and underlying trends. We're seeing again here that there's a little bit of a bubble up in inflation, and even with yesterday's CPI print, which came in below expectations, slightly below expectations, was certainly an encouraging signal. And the year-over-year price pressure is too high. And this is one of the primary reasons that when we think about what's going to be happening on interest rate policy going forward, our kind of base case is that there are going to be less interest rate cuts than what the Fed had priced in their most recent summary of economic projections, the fabled dot plot. The median estimate was for 2 cuts this year. Our expectation is for 1 or none as a more likely outcome. And when you look at the broader market, they're kind of in line with that expectation as well. Currently pricing in, I believe it actually switched since CPI. It's kind of oscillating right in between 1 and 2. It had been 1 for most of January, including when we saw that really impressive labor market report from last Friday. The expectation changed from March to October at that point, swung back to March, and now potentially looks like there might be a second cut priced in towards the end of the year. Again, there's going to be a lot of fluctuation here, and that's what this chart really highlights. When we look at last year and we look at how much fluctuation and how many times the shape of the curve and the shape of expectations fluctuated, that's a tale as old as time. That's something that is always happening. So the important signal is that if you're looking too closely at what the market interest rate cut expectations are on any given moment, and if you're kind of tying yourself to those expectations, you're kind of missing the point. You're missing the broader picture. The broader picture is that very clearly the U.S. economy is the envy of the world. You can kind of go down the laundry list of all the different signals and factors that we're looking at. There's long sustained health kind of in a very near term. And some of the policies which we'll go into in a little bit certainly are going to be benefiting or impacting positively the growth potential in the very near term, over the next couple of years. Speaking on interest rate policy and maybe tying it before we get into some of the tent poles for the new administration, when we think about the industrial sector and we think about one of the major components, mortgage rates, the household sector, the demand for steel that comes from the household sector, whether it's appliances, even more broadly, HVAC, the automotive sector, all of these things are very closely related. One of the better kind of signals to be looking at is obviously what's happening with mortgage rates, where demand is, when you think about new housing, existing housing, kind of the churn that comes from existing housing. There's a change in expectations and some fluctuations that we maybe want to dig into a little bit more. So what we're looking at here is going to be the mortgage rates in blue, and then the percentage of mortgage applications which are for refinancing in orange. So as you can see here, there's some pretty significant divergences over the last 5 or 6 years. As we had throughout 2019 and into 2020, a kind of slow, steady reduction in the 30-year mortgage. We saw a pretty significant surge in refinancing applications. Again, as a percentage of overall applications, the vast majority of what was happening in 2020 and in 2021, on the base of applications, was really refinancing. A lot of people were really locking in extraordinarily low, in our view, probably record low levels for those mortgages. And when you kind of move back towards the consumer, this is a big part of what we're talking about in 2019, 2020, 2021, all of this refinancing, kind of locking in lower levels of debt, non-revolving debt, really has given the consumer a lot of leeway and a lot of runway for higher levels of consumption, or a change in the mix of consumption. Now, that obviously changed pretty significantly when inflation kind of got out of hand and interest rates started to hike. So as we could see, even ahead of the Fed hiking interest rates, mortgages had started to climb in the beginning of 2022. And alongside that, obviously we saw a sharp reduction in refinancing. Now, as mortgage rates have been kind of holding above that, right around that 6.5 to 7.5, even up to 8 level, the activity on refinancing was extraordinarily low. But what we're seeing is a real reactive buyer or mortgage owner, and that's most clearly seen, most acutely viewed in what happened right around the time that the Fed cut interest rates. So that is going to be this period right here. Since the late spring, we saw kind of a gradual decline, and mortgage rates get down to one of their lowest levels that they had been in a long time, and subsequently all of the mortgages that had been purchased, the homes that had been purchased, people were very closely watching interest rates, and refinancing surged. Subsequently, what happened on the mortgage side, which was not expected by the broader economy, was a surge there. So it's a simple supply demand, kind of a simple supply demand function. What this means to us is that we do not expect or anticipate mortgage rates to get down to 6.5 or down below 6 for the entirety of 2025. We expect a higher mortgage rate kind of for a prolonged period. Kind of every time that we start to see it dip down, we do expect a pretty significant surge in refinancing. And when you think about what that's going to mean for the housing sector, we expect that a lot of the themes that we had been seeing previously with starts and permits, kind of at higher levels in 2019, we do expect that to continue. We expect that the new home side is going to continue to have some beneficial impact from just existing homes being too expensive, and from mortgages being especially high, and inventories for existing homes, we expect them to remain reduced as well. So when you think about what that's going to mean for the rest of the year, a lot of people thought that when the Federal Reserve started cutting interest rates, that mortgages were going to just automatically be coming down. This is an important thing to keep in mind for the next couple of years, for this current year in particular. Now, moving on to some of the things that we're thinking about when we look at policy adjustments going forward. Obviously there's going to be a lot more clarity on Monday for exactly what's going to be happening. It sounds like there are a lot of day one policy actions which are going to be implemented. What we've been able to kind of glean are these 4 major components which are likely going to be impacting the industrial sector more specifically. And we've kind of broken them down here. The first 3 are kind of all going to be tied together, and then the final one on the immigration side is going to be a little bit different. So the lowering of the tax rate to 15% for manufacturing that's made in the United States, a clear bias towards tariffs. whether that's gradual or whether that's all at once, and in a general trend towards reduced regulation. Those are all going to have similar impacts. Overall, in the near term, we do expect that those are going to really benefit an industrial sector, which has been under some significant pressure, largely because of interest rates over the last 2 years. We think that that all three of these are really going to have a pretty beneficial near-term impact on the industrials, on the steel sector specifically. We'll get more into some of the individual components as we kind of look at how everything's evolved over the last couple of years, but it really does incentivize increased utilization for U.S. capacity, creating global restrictions, pushing out global activity, pushing out, specifically in the steel world, global dumping and overcapacity, and just really incentivizing continued reshoring and continued investment in manufacturing. Over the longer term, we expect that that's just going to kind of keep the elevated levels of investment, even higher than they are now, kind of where they are, and even a little bit higher. Improvements on economies of scale from reduced regulation standpoint, and increased domestic and nearshoring supply chains. There are some longer term risks that certainly do need to be recognized and observed, especially when you look towards the tariff side specifically. There are a lot of cases of countries that have those kinds of restrictions that protect domestic industries, and some of the kind of plateau of innovation and technology that can come from that's just a risk that does need to be recognized and appreciated. And the potential for some overcapacity coming into the United States specifically, in reaction to an expectation of more reshoring. The immigration side is a little bit trickier. It certainly is more muddied. We do see in the very near term that if immigration policy does become too restrictive, that it just is going to heighten the risk of a skill mismatch, and resurgence to wage pressures, which really impressively and against all odds were kind of kept in check throughout this entire inflationary surge. Wages never really got out of hand, and they've been more slowly than I think a lot of people expected. They've been coming back down to normal levels. If the labor market gets too tight, there is a real risk of a surge in wage pressures. And then, over the more long term, depending on what the level of restriction is, there is a risk of reduced economic growth, over the longer term. A lot of research, a lot of economists have really talked about one of the main reasons that the U.S. economy has been in such good shape and has recovered from the pandemic so well is largely because of a significant surge in highly qualified workers and immigration more broadly, that really benefited our economic consumption and our growth potential, productivity as well. So those are kind of how we're seeing it currently. Again, more information is going to be clear very soon. Now we'll kind of turn more towards industrials more broadly. This is kind of the big thing that we need to always be keeping in mind here is what's going on in China. Obviously, Chinese production is more than 50% of the world's steel production. And what we saw over the last 2 years is a really high cause for concern. So obviously, a large part of 232 was put in place to address the overcapacity and the dumping on the Chinese side into the U.S. That has been broadly a success, a really impressive success. When you look at it on face value, Chinese exports, cheap Chinese steel does not come into the U.S. anymore directly from China. So what we're seeing now is that this surge of exports is very clearly, in large part, being passed through other countries and then coming to the domestic shores. case in point, the trade restrict or the trade case that came forward in the fall of last year, and the action that absolutely is going to be coming forward, should put some of the caps on this. But when we look at the global steel industry and we look at what's been going on with global steel pricing, specifically in Europe, they've been negatively impacted, severely negatively impacted by the fact that there's so much Chinese overcapacity and that their domestic consumption currently is in such poor shape that the only way that they're going to continue to grow at their 5% expected level is by exports. So this is a problem that's not going to go away, and it's not going to have an easy fix when we look at the global markets. China is going to continue to export steel in the very near term. So that's going to require a lot of vigilance in the U.S. and in countries that are our partners as well. As I mentioned, when we look at the U.S. more specifically, and we look at imports into the U.S., we have a chart that we like to bring out in all of the FFI lives and in a lot of the research that we publish as well. We have our forecast model. It's based off of our supply demand estimates for kind of where the holes are or where the domestic global prices are kind of fluctuating. What we can see here is that essentially since the expected surge, which did happen, but didn't go to quite the level that we had anticipated earlier in the year. Since then, imports have come essentially right in line, and any fluctuation that we do see has certainly led to some pretty significant price movement. So when we look at imports going forward, we have the dashed horizontal line here, which is kind of that neutral rate. The takeaway, which is pretty interesting, is that through the end of the first quarter, we do anticipate imports to kind of remain above that neutral rate. And going forward, the increased restrictions certainly should keep imports in check. But in the very near term, as we think about people potentially trying to get ahead of tariffs, as we think of where demand is, where price pressures are, and the fact that global prices have been significantly lower than U.S. domestic prices, we do expect still a little bit of a bump in imports, even though they're clearly trending lower from the really problematic levels that we saw earlier in the year. And then we move on to domestic production. What's really been interesting on the domestic production side, when I want to draw everyone's attention maybe to what was happening in 2024. It certainly was a surprise to see an overall uptrend. So what we're looking at here is going to be weekly steel production with in the bar charts, and then we have a 4-week moving average, which reduces a lot of the noise. In orange, you can see that throughout 2024, there was a very clear uptrend in domestic production. Earlier in the year, we saw the surge in imports, and then those kind of draw down. When we look at the dynamics on steel pricing and the just slow drag lower that kind of consistently had happened, it's very clear that there just was too much steel available, that inventories were too high when you look at the whole supply chain. This is really the story of 2024 is a lot of overcapacity, just too much material, a pretty significant surplus that's taken time to work through. And you can see more clearly that domestic producers finally owned up to the narrative that very clearly was happening. We saw sharp cuts to production, surprisingly sharp cuts to production early in the fourth quarter. But since then, we largely in our view, because of expectations of higher demand, we've seen an uptrend. It's maybe leveling off at below trend levels, but we are clearly in an uptrend. And again, as I had mentioned, we'll move more into demand from this point forward. Expectations for demand certainly are encouraging, and you can see here that mills are anticipating those increases to demand as well, and potentially trying to get ahead of them as well. The chart that we're going to be looking at here is going to be construction spending. So the total construction spending is in the solid blue line. We also do have total residential spending in red. We have non-residential spending in yellow. What you can see here is that, essentially since the beginning of 2019, residential spending really was driving overall construction activity, while non-residential spending it kind of leveled off. Following that surge in residential, as we typically do see, we saw a real nice increase in surge on the non-residential side, which is somewhat leveled off. As we had mentioned before, we do anticipate that residential is now going to be kicking into gear, while the growth rate for the non-residential side is potentially going to be leveling off a little bit. One of the more notable or interesting things when we think objectively about really what was driving a lot of construction spending on the non-residential side has been a really impressive surge on the public spending side. So when you think about a few of the policies over the last couple of years, the investment that was taking place, there was a real big beneficial increase to a lot of the non-residential spending that we had seen. When we dig more specifically into some of the other steel components, the next set of slides here are going to be some of the ones that give us the most optimism about reshoring, about the U.S. domestic manufacturing base, and the potential for where steel consumption is going to be going in the next couple of years. The chart that we're looking at here is the percentage of manufacturing, or the percentage of construction spending that's going specifically towards manufacturing. So this is from the beginning of the data set, which started in 2002, the kind of long run average that we had seen. So the amount of construction spending that was being put towards manufacturing facilities was a little bit less than 5%. A slow kind of growth, obviously a softer manufacturing base. And then what we've seen more recently over the last couple of years is that that's more than doubled. So a lot of the reshoring that people have been talking about, this is the proof positive version of that. This is the clear implication that there's been a change in mindset, that there's been a change in activity, that the investment that's happening on the manufacturing base is in fact really going to bring long-term benefits to where industrial activity and steel consumption is going to be coming online. That's shown here in the chart that we're looking at now. So the blue line is one that this chart is one that we've highlighted in a few FFI reports as well, or a few FFI lives as well. It really is impressive when you objectively step back and take a look at the potential for industrial production going forward. So the solid blue line is industrial production. It's the index of how much output is coming from the industrial base, which is predominantly manufacturing. The orange line here is going to be capacity utilization. What I'd like to draw everyone's attention to initially is going to be this period in 2018, September of 2018 specifically, when the index itself peaked. So we saw the highest level of industrial production occur in September of 2018. Now, over the ensuing years, we obviously saw a little bit of deterioration, and then more or less a recovery occurring following the pandemic. And what's happening underneath the surface, though, is much more important. When we look at today's activity levels, while they're certainly above clearly where the pandemic was, clearly above 2019 levels, what we're really encouraged about is the fact that capacity utilization is so low compared to where activity is. So if you would extrapolate it and take and take a look at the investment, and you would take capacity utilization of the prior peak at 80.6%, what you would see very clearly here is that at the level that we'd be seeing of activity is more than 7% higher than what we had seen in that prior peak. So it's a clear signal that a lot of the activity, a lot of the investment that has been happening is now starting to come online, and the potential for consumption, for steel consumption, really has a rosy outlook and a rosy future. And when you think about some of the incentives from the incoming administration, it's more likely than not that we're going to start to see the benefits of the last couple of years of investment sooner rather than later. Taking a step back, obviously with clear eyes, actual manufacturing activity clearly, as we saw in the chart below, has been severely restrained. The chart that we're looking at here is going to be the aggregate Fed surveys in blue. We have two other measurements of manufacturing activity of PMIs. So S&P global manufacturing PMIs in yellow, and then the ISM, which is the one that we watch most closely, is going to be in orange here. Again, overall, it's been about 25 years of an industrial manufacturing recession. That certainly has been felt more broadly. But when we look to the trend, we do see an uptrend kind of going into the end of the year, and even some of the preliminary data that we had seen. For anyone who caught the one of the Fed surveys today, the Philly Fed index reached a 3-year high, driven by production and new orders. So we're clearly starting to already see a lot of the optimism that maybe was coming through some of the sentiment surveys is starting to kick into gear. It's a matter of time. It's not something that's just going to be a flip of a switch overnight. But when you look at the underlying data, there are a lot of green shoots to be encouraged about. Another component of steel consumption that we've recently been hearing a lot about is coming from the automotive side, which is another sector that over the last couple of years has really been suppressed as well. So just for some table setting, the level that the level that has been observed as kind of a healthy level of auto sales is that 16.1 million annualized level. What we can see over the last 3 years was that clearly we were in restrained activity. Affordability was a real concern, and production and inventory levels were kind of following suit there. That there really wasn't a ton of demand for autos. Partially hampered by the chip shortage that had occurred, but once that was resolved, autos just were too expensive, and demand for them was reduced. What we have seen more recently, though, is a real surge, a real encouraging trend on the automotive sales side. So over the last 4 months, we finally broke above that 16 million level. In October, we far surpassed it in November and saw an even more encouraging signal on December. What's really interesting when you dig into some of the other components, some of the other details on the data, is what was happening on the auto inventories, which is in orange, and the auto production side. So you can see pretty clearly here that the surge in sales was not something that manufacturers were necessarily anticipating. And how you can see that is by essentially since 2023, since the second quarter of 2023, we saw kind of general trend of lower production. A little bit of a glut on the inventory side. And then as soon as auto sales started to really kick in, it's been a drawdown in inventories rather than a surge in production. So it clearly shows that this was not necessarily an anticipated increase. Partially that does, not to be too negative, but that does throw some cold water in our view on some of the activity that had been happening. We do anticipate that this is going to be short-lived, and that some of the steel consumption, which is going to occur, which we anticipate to occur on the automotive side, we don't see it necessarily as a real durable steel consumption kind of going forward. The main reason for that is just to kind of like tie everything up here is going to be the survey responses from the University of Michigan Consumer Sentiment Survey. The chart that we're looking at here is the answer, or is the output from the answer of, is now a good time to buy a car? Clearly, going back to 1995, we're very, very repressed levels. By and large, the cost really is a huge concern. So We anticipate that while over the next couple of months, there's going to be some increased auto activity, some increased auto demand. We don't see this as a long-term durable source for demand compared to manufacturing, which we're much more optimistic for, which we do anticipate to really start kicking in more in the second quarter of this year. So with that, a lot of information there. Hopefully, I was able to kind of touch on everything that our viewers were interested in. I'd love to switch back over to Haley and hear some of the questions that have maybe come up. Before we do that, I do want to plug the next FFI Live. It's going to be on April 24th. So in about 3 months' time, same time, I'll be in the same place here in our Chicago office, and look forward to another opportunity to hear back.